Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. In tonight's program, I decided to take a look at getting income out of the stocks that you invest in. So I've got Bogdan from Blackmore Capital to talk to us about the three top stocks he likes in his fund, which of course is a dividend growth fund. And then Raymond Chan will look at what we learned from the stock market last week, those two beautiful days, a 5.5% rise, primarily because the market was anticipating maybe a better run of data around US inflation. Didn't happen, but boy, when they expected it, the market did go up. What were the big lessons there, and what stocks does he like right now, and what stocks does he not like right now? And then Paul Rickard focuses in on a high-flying stock that he thinks is really good value right now. It's a stock around $5 or so, but the analysts think it should be $6 or more. So that's the show. Let's kick off now with Bogdan. Well, joining me now is Bogdan of Blackmore Capital, who also is the fund manager for the Switzer Dividend Growth Fund. I'm keen to know what are the three stocks in his portfolio which he sees are the most reliable, the ones that he knows will keep on delivering good, reliable, dependable dividends. Marcus, thanks for joining us.
Morning, Peter.
Let's just recap on what you do in the Switzer Dividend Growth Fund. How many stocks do you put in it?
So we can hold anywhere between 20 and 40, but over the course of the history of running the fund, we've averaged around 25 stocks. So that gives us sufficient diversification, but also allows us to really overweight key themes in the portfolio as well.
Okay, obviously the unit price jumps around with the stock market. You're a slave to what the stock market does. But since you've been running the fund, what has the fund been returning before franking and then after franking?
In terms of dividend yield,
yep.
Currently the dividend yield is comfortably over 5%, and when you gross that up, it is over 7%. Today. So there is definitely a focus on higher dividend paying stocks, but importantly, we want those dividends to be resilient as well. And hopefully companies that are able to grow their earnings through the investment cycle, so that allows those dividends to grow as well. So that's a really important caveat for the portfolio. Yeah. You want sound economic growth, which underpins sound dividend growth.
Okay, so today I want to ask you, if you look at the stocks you've got in the portfolio, for people out there who might want to build their own fund, you probably prefer them to invest in your fund, but the bottom line is, what are the three, what you think, most reliable, dependable dividend payers in your collection of companies?
Well, the three are each leaders in their particular industry, and the three would be Amcor, which has a stated objective of growing capital and dividends through the investment cycle, and they've done that particularly well through the pandemic. It's been one of the few stocks that have really delivered consistent earnings growth, earnings at the upper end of their guidance, and that's translated into very attractive dividend growth. So that's number one.
Before number two, with Amcor, is it in the right sector as well, in the age of people buying stuff online and the whole logistics stuff that the world depends on becoming far more important because people aren't going to the shops as often, but they're buying stuff online, and therefore cardboard boxes and the whole delivery process is far more important than ever before?
Yeah, look, that has played an element. It's important to recognise who the key customers are, and that is primarily consumer staples. So it's fast moving goods, very much in the beverage category. In healthcare, they do a lot of work, whether it's in pharmaceutical packaging or hospital packaging as well.
Yep.
And they also, an area of significant growth for them has been coffee capsules, which are obviously been increasingly popular, and pet food. And all of those things require packaging. What is important as the industry leader is that they move down further into sustainable packaging, and Amcor is certainly a leader in that area as well.
Okay, let's go to the next one. What's the second most reliable company?
Well, very much a household stock, Commonwealth Bank. Since floating on the Australian Stock Exchange in the early 1990s, it has been a very reliable dividend payer, and with a very strong balance sheet, and has executed consistently better than the other three retail banks. We continue to like Commonwealth Bank as a steady provider of good income growth for our investors.
Yeah. So around, what is it currently paying around now?
So the dividend yield for CBA is around 4%. It is lower than the other three majors, but I think that's primarily because of the quality of the book, that you are paying a slightly higher valuation and a slightly lower dividend yield. But I would argue that the dependability on the earnings and the dividend yield has been stronger for Commonwealth Bank.
Yeah, and I must admit, I often say when people ask me about CBA that whenever the market wants to sell off, it's a good time to buy the CBA because effectively your dividend yield goes up when it eventually sees its share price rise again.
Indeed, and that has been the absolute pivotal part of their history over 30 years now.
Yeah. Let's go to your third one now.
Third one is, again, industry leader in the staples category, and that's Woolworths. It pays a dividend yield of around 3%, but has been able to deliver very consistent growth. It is the market leader, ahead of Coles and Metcash and the discount grocers. And we think that they've executed particularly well through the pandemic. They've been able to grow their online presence. They're an industry leader there. And grocery sales continue to be reasonably strong.
And once again, when these big names get trashed by the market, often by the short-term players who move from sector to sector, if you pick up a company like Woolworths when the share price is down, over time they invariably rise, plus you're getting a reliable dividend, which goes up effectively in yield terms if the share price goes up.
Indeed, I think that's a really important lesson for investors, is that focus on those quality Australian leaders that have been able to deliver dependable earnings and dividend growth over several decades.
Okay, one last question, Marcus, because there is a belief that it's always the big names that deliver dividends, but occasionally there are smaller companies that you would, I guess, invest in that also have had a good history of paying dividends. Can you give us the name of a smaller company that actually is a good and reliable dividend payer?
Well, in the mid-cap part of the market would be Cleanaway Waste Management. And so again, a central industry leader, and they have been able to grow their earnings through the cycle at attractive levels, and that's translated into a much higher dividend growth compared to some of the larger companies. So underpinned by strong balance sheet, dependable earnings, those earnings are growing as they're getting greater market share, and that's translated into attractive dividend growth.
Yeah, is there, listening to your observations and your selections, it seems to me that you're very keen on selecting the best of breed in any one sector. Is there a history that tells you that is a really reliable way to not only get dividend yield, but also get capital growth?
Yeah, it's a significant point that you raise. There is definitely an emphasis in the portfolio for quality. We believe that the quality through the investment cycle gives you the safest types of returns, because they're far more dependable, and they have got a clear history of being able to deliver those results through a range of different economic circumstances. And where we sit today, where there is a whole myriad of challenges that we're facing from an economic point of view, it's those sorts of companies that are really important ballasts in the portfolio.
Yeah, it's funny, as I was listening to you, I thought of one company that once upon a time was considered best of breed, was a great dividend payer, but AMP has really lost it, hasn't it?
Well, yes, and that's why you've really got to study these companies very carefully. You can't just put companies in the bottom drawer. You've got to follow their history. You've got to follow how they're executing. And also there are companies that lose their leadership mantle. And AMP is one of those companies. On the other hand, companies like Macquarie have just gone from strength to strength over the last decade or so.
Yeah, I guess the bottom line is, once that trend becomes consistent over a number of years, it probably is a sign that you should get out.
Yes, and I do think that that history of execution on companies is particularly important to follow, and you've got to look at the direction of travel. Are those companies creating shareholder wealth consistently? And that's why I pointed to the three companies at the beginning of this segment, which are very good illustrations of companies that can do that over the course of time.
Yeah, Marcus, thanks for joining us.
Pleasure. Thanks, Peter.
That's Marcus Bogdan of Blackmore Capital. Well, it's a negative day on the market, and we kind of expected it after what we saw from Wall Street with that very good job number, which kind of implies that maybe inflation in the US isn't coming down as fast as we would like. But last week, on the anticipation of possibly a good inflation number in the US, or a good jobs number in the US, and the fact that our inflation wasn't all that bad, and the Reserve Bank only raised rates by 0.25%, we saw in 2 days the market rose 5.5%. So I'd love to see what Raymond Chan thinks about that. What was the lessons from that, and what stocks he either likes or doesn't like right at this moment. Raymond, great to see you.
Peter, good to see you.
2 beautiful days last week, 5.5%. I saw it, Raymond, as a sneak preview of what might happen when inflation looks as though it's under control. Agree?
Yeah, it does. I mean, one big thing I always look at is the shipping costs. So even if I look at the Baltic Dry Index, it's all going down.
Yeah.
So this is a good sign of inflation going down. However, there's one thing is really, really hard to go down at the moment, is the wages.
Yeah.
So in US, in Australia, our unemployment rate are at a record low. So it's certainly getting harder. So this is something I guess the Reserve Bank will have to deal with.
Yeah, and it seems to me, Raymond, that I think I did read that rents in the US were going down, but rents here are going up. So there's a whole bunch of prices heading in different directions, and the statistician will eventually come out and probably surprise us with a good number. When that happens, at least for a couple of weeks, do you think the market will say, "You little beauty, let's buy," but they'll be waiting with trepidation for the next month to make sure it's continuing to fall?
I think to answer the question, we have to take a step back as to, where is this volatility coming from? Because like from the 1st of July to, maybe a few weeks ago, things looks pretty good.
Yeah.
It's all happening because of the yield curve. So to demonstrate yield curve is a comparison of the short-term and the long-term rate. When the yield curve is downward sloping, this means the market is expecting the interest rate to go down in a long period of time. That is very beneficial for the equity market. Okay, so what happened 2 weeks ago when the Federal Reserve lift rate higher than the market expected? They sent a message that by February next year, the Fed fund rate could gone up to 4.6%. Remember, just a few weeks ago, the markets was thinking about next year we have a rate cut. So that effectively moved the yield curve to downward sloping into more flat yield curve. So this adjustment alone create problem with the bond market. So when there's short with the bond market, there's short to the equity market. And this sort of short is going to take weeks to resolve, according to our strategist, Michael Knox. And so what we're seeing now at the moment is, it's just this volatility, market adjusting their expectation. And why the Federal Reserve want to do that? Because they want to create an intention that we're going to dry up the bond rate to send a signal, back to your question, to fight the inflation.
Yeah. So in a sense, it's like a scare campaign to scare the consumer in the US, to scare the businesses who are setting prices and creating inflation, all that sort of stuff. And I guess the quicker it works, the quicker the market will turn around and start going up rather than heading in a downward direction.
Yeah, that's true. Because when I look at the fair value of ASX 200, it's still 7,200 points. And we just mentioned about the bond market sell off, but it's funny enough, our research team suggests the Australian 10-year bond is the only bond in the OECD country that yet to have a bond yield higher than the year high. So a lot of bond yield reached a high in June, and now we have another record high, but not with Australia. Why? Because we have a record current account surplus. And it's very timely because we are about to have a Federal Reserve, a federal budget on the 25th. And we are in a very good shape. That's why our bond market has stabilized. And that's important to the equity market because the stabilization of bond will allow us to maintain our fair value. So the market at the moment, a week ago, we're 700 points below the fair value. So the market is cheap. Today, I think we're about 400 points below. So, slightly cheap. And
what I found interesting over the weekend when I was knocking up my story for the Switzer report, that our market was down, I think, 7% year to date, but the American market was down 16. So, it's a reflection of that we are in pretty good shape. The fact that our inflation number fell, albeit not by much, but still it was enough for the Reserve Bank to say, well, we'll test out a 0.25% rise rather than a 0.5%. I guess the bottom line is if that trend keeps continuing, our market could outperform.
Absolutely. And also there's a lot of, I read a lot into the CBA forecast of, they stand out.
They got it right.
They say 0.25%. Okay. Why I always believe, CBA got figures well ahead of the market because of the dominant customers' position they have.
They know what consumers are doing because they have most consumers banking with them.
Yeah, and this is a good sign. Things may not be looking as bad.
Okay, let's go to the stocks that you either like or don't like. And the first one over here, energy stocks. You're a big fan of energy still.
Yeah, I think so. At the moment, given whatever happened to the world, we have a lot of geopolitical conflict. And, surely, Europe is in shortage of LNG at the moment. And surprisingly, China, this year they hasn't import as much LNG as before because of the lockdown.
Yeah.
So now we think about the energy demand will continue to be high, especially on the LNG.
Yeah.
If China coming back to the market next year, assuming, after what I call a 2 session next March, they continue to reopen, there will be tremendous demand for LNG, and I think Australia will stand to benefit.
So what companies do you like?
Well, at the moment we like Santos. Yeah, Santos is we can arguably say, it's a complex story because they got their producing mine, they also got, some of the future investment. But if we look at the key one like, the PNG, LNG, or in Australian Eastern Seaboard, the Gladstone LNG, they're doing really, really well. More importantly, many years ago, if we all remember, Santos carry heaps of debts.
Yeah.
And the current management team paid down a lot of debt. And with the recent announcement of, sell down 5% stake in the PNG LNG, that would likely to cut the gearing level further down to maybe around 12 to 13%. So what it means, the implication for shareholders is there could be capital management from Santos, and also the yield last year will be below 3%. This year the yield could be maybe around the 3.7, 3.8%. However, this is a very sustainable yield we talk about because they fixed the balance sheet.
Yeah, and the outlook for prices are good.
Yeah.
Okay, REITs, you've got a tick for REITs. REITs have struggled over the last few years. Tell us why you like them now.
Yeah, usually over X many years, I usually find investing REITs when they are trading well below the NTA will be rewarding for long term. You may not get a result for the next few months, but over the long term, I think they will do well. The like of Mirvac, I know a lot of people worry about public trust at the moment, but at the moment you are paying 35% discount to the NTA on the portfolio of assets. So their office, their shopping center and the like. However, you got their funds management business, you got their property development business free of charge. And the business itself or the stocks itself offer 5% dividend yield, and the gearing level is nowhere where they are during the GFC time. Around the 20% at the moment gearing ratio. I think it's very sustainable. So those who you're paid to invest and be patient, and on the next cycle, I think they will do well.
That's Mirvac.
Yeah.
Okay, and I guess down the track, interest rates will hit a high and they'll start coming off the boil, and REITs compete with interest rates, don't they?
Yeah, that's true. And high interest rate will continue to be a theme to look at in terms of investment. That's for sure.
Okay, I've asked you what companies you don't like. What are the characteristics of companies you don't like? Then I'll make you name a few names.
Well, maybe I try to avoid names, but I typically try to avoid company with high level of debts.
Yep.
Because obviously, many of us been through the period of GFC, or back to the old days, the tech wreck. You know what the debt can do to the company. So typically, if the company don't have an interest coverage ratio of over 3 times, I'm less interested to invest in them at this moment.
Okay, so what companies are on your I don't like list?
Well, I wouldn't say I don't like, but I would be more cautious.
Yeah, well, I would not invest in them.
Yeah, a very popular one like Transurban. Yeah. Yes, they offer some inflation hedge, that's for sure, because the toll is CPI linked. However, they do have quite high level of debt in the system at the moment. So I think on the sustained increase in interest rate that can impact not only on the debt level but also on the valuation as well.
Are you looking at the current share price of Transurban and its debt issues? Because if someone who bought Transurban at $7 or $8, you're not telling them to sell, are you? It's just like you're kind of saying, don't buy at these levels.
Yeah, that's true. I mean, for the holder, I'm happy for them to hold because this is a long life assets. Yeah. And on the depressed share price, there will be global super funds or funds manager. They want to buy them and hold forever. Yeah. It is more, my cautious is more for those who do not own this company at the moment. Yep. I will be more cautious to buy them at the current level.
Okay, it's nice to on this show to have someone being negative on something, Raymond. Is there another company that you just don't like at the moment for debt reasons?
Well, it's hard for me to pinpoint name I don't like, right? In a public forum, right?
Okay, or how about a stock you won't buy? That everybody, like for example, like I'm always happy to say I like JB Hi-Fi when the market belts it up because it's a great company. Yep. And if you can buy at a low price, over time, historically, it always comes good and it pays a reasonable dividend. I'm comfortable with that. Yep. But there are tech name companies that I wouldn't recommend when
Yep.
they're at high prices.
Yeah.
Someone would bring at low prices. But is there a company out there at the moment that you think people might think, like, give a classic example. I haven't liked AMP for a long time. And part of the reason, because it was always heading down. Particularly after that first big drop from the 30s down to about $4 or $5, it has never ever recovered. And as a company, when people say, "Oh, I buy it for income," I said, "Be careful. You can make income, but you could lose a lot of capital." Is there a company like that that sticks in your brain right now?
Yeah, well, there's certainly a lot of company not meeting my investment criteria.
Very high standards.
Yeah, because I guess by default, I don't invest company with no earnings.
Yeah.
Because back to the uni days, when there's no earnings, I don't have a valuation. It's only when I joined the stockbroking industry, I realized,
So when you're at university, you were a mad stock player, were you? Yeah, how's that?
I started investing
So if
into
you're
it.
a young person who's lost a lot of money, he was like that too until he grew older and smarter. But go on.
So a company like like BetMaker, it is
BetMaker, classic case.
It's a company where that there's certainly they have EBITDA, but it's yet to
It has
arrive.
blue sky, but gee, it could be a long way off.
Yeah, it yet to announce a net profit as such. So I would need to be convinced. But certainly the company got lots of debt, cash at the moment.
Yeah.
So and also there's a number of high tech company that I have to be mindful. There's a lot of followers out there at the moment, but they don't make profit.
Yeah.
And while some of them actually have an EBITDA positive, however, because of the CapEx profile, so the amount of money they have to invest into the business, it will mean that there will be a long time before they can generate net profit. So this is, I guess, something we have to be mindful. In the bull market, it's easy to raise equity for them to grow, but in a bear market, as we're in now, we just have to be more mindful.
Great stuff, mate. Thanks for joining us.
Thank you.
Raymond Chan of Morgans. Well, Paul Rickard's back from his swanning around the world trip, and ironically, he likes a company that's very much linked to the high-flying traveller. Paul, good to see you.
Yeah, I wouldn't call it swanning, Peter, but look, part of it was leisure.
Did you travel business class?
I did travel business class.
That's swanning most.
But I could tell you, Peter,
You worked the whole time.
I did. There were a couple of flights at economy and going across to Europe, and every flight I went on was chockers.
That's right. It's amazing, isn't it? And I look, obviously some people can't afford to travel right at the moment, but the people who can, that demand curve is price inelastic, isn't it? They're paying it and they're travelling.
They are. People are travelling. I mean, the other two stories, Peter, is that, look, I've talking to people in the UK trying to get a flight back to Australia. They couldn't get a booking. And I've just booked tickets again to go in January, and prices are through the roof. And that accounts for all the experiences in the domestic market.
Yeah.
I've heard some outrageous fares being charged between Sydney and Melbourne.
Yeah, $900 one way.
Yeah.
Oh, we've been a victim of that one.
So the run up from that was, I mean, one of our early people who used to be a big guest on our show, Charlie Aitken, used to say that some of the best investment ideas are things you can actually, look and see and touch. And although I've always steered clear of airlines because of, they do have what we call that exogenous risk.
Volcanoes.
Volcanoes or, heaven help, a plane crashes or something. Yeah. And, that's something there's an uncontrollable risk factor. I just think that, what's going on at the moment, and Qantas is a great example, is going to be fantastic for their profitability. And the question I think people have always got to ask themselves is this already in the market or not? Yeah. And one of the things that's been interesting looking at how the pandemic has played out in Qantas is it's really the share price has been pretty stable now. Sure, it dipped in February 20, but as people realised that at some stage the borders would reopen and flying would come back again, the price has held up very well and are still in that sort of low $5 category. And to me, that still looks like really good value because we know that Qantas took the opportunity of the pandemic to do a lot of cost cutting.
Yeah, lost a lot of pilots as well.
Lost a lot of pilots. We know that capacity is coming back, and even in their last quarter, the capacity is up, and they've got a long way to go. So there's still a lot more upside.
Well, what are the brokers saying?
Yeah, the analysts have a target price of about $6.40, so that compares with today's price of about $5.20.
Yeah.
All the major brokers are bullish. There's one who's a bit negative on it, but it's more so just because I think it's the way that this broker sees the stock looks at perhaps the slowing of the economy impacting demand. But I think there's still so much money around, Peter, and people are catching up for 2 or 3 years.
Yeah.
I don't think this travel thing's going away in the short term.
And it's demand compared to capacity. And remember, in the old days, we had Tiger Airlines, not there anymore. So it's just Jetstar, Virgin, and Virgin is not competing like it used to, particularly in business class, where Qantas makes a lot of money.
It does, and what Qantas has said in the last couple of months. Now, I want to talk about the problems they've had, but that they've actually started to reduce capacity where they need to actually just manage that really tightly. So, it's a duopoly system. It's hardly a duopoly. It's almost a monopoly now in many cases.
With a price leader model.
With a price leader, and Qantas is raking in the cash. And I don't think that's... Sure, the market expects, travel to recover and is recovering. I just don't think that's in the market enough. So that's hence my bullishness on Qantas. Downsides, well, number one is the oil price.
Yep.
So Qantas has said that their fuel bill will go from something like about just under $2 billion last financial year to about $5 billion this financial year. That's a big increase. Now that's partly because massive more capacity in terms of more planes up in the air, so that means they've got to buy more fuel. Yeah. But it also reflects the fact that they've had to re-hedge and oil prices have gone up, and so that's an impact. Now they're saying that that's going to be basically compensated through higher ticket prices, which they're getting back. Yeah. But that could get worse if if the oil market goes goes further.
But as I listen to it, Paul, I know it's a downside, but it could end up being an upside if the Ukraine war ends in 2023 and oil prices fall. Yeah. So they've written in a high cost, which might not be.
So that's one. And the other thing is going back to the problems they had in May, June, July around cancellations, the phone call wait time, people can get through to their call centre, huge lots of lost bags and everything. Look, they seem to have addressed most of those. Those metrics have come back in order. That's required Qantas to employ some more people. So there's some extra costs there. So they're said to me the downsides apart from just the normal airline risk. But it's not overpriced, Pete, and I think there's upside.
Well, one aspect of Qantas which I think is really interesting is that I know Maura, my wife, has booked hotel rooms on Qantas. They now selling healthcare.
Yep.
The way they're using that website, it's giving them diversification, alternative streams of income, which they never had before. But this is a great database to market to. I reckon there's enormous potential in that, which is going to reinforce the position of this company going forward.
Well, that's what they call their loyalty division, and it actually grew earnings last year. So notwithstanding that, and they've got some, and part of that, Peter, is actually getting more partners onto it, but also getting people to redeem points. So they actually want to encourage that. So
I know we got rooms in Greece purely for the Qantas. Website, which wouldn't have thought of unless they marketed it. So there's an enormous database, and I guess some people will even start looking at its health offering as well. So it's quite extraordinary what they're going to do there.
14.1 million frequent flyer cards out there. So it's a huge database, right? So
it's over half the population.
It's over half the population. So that's all the positive points, and I think there's value there. So and pricing metrics look okay.
Okay, Paul Rickard from the Switzer Report. That's the show for Monday. Look forward to seeing you on Thursday. And don't forget, if you want to get more information about investing in stocks, have a look at switzerreport.com.au. Thanks for joining me. See you on Thursday.